Whatever brought you here today, stay with this video for a few minutes. Because one of the most misunderstood risks in the stock market is not a stock falling sharply. It is the possibility that an investment can eventually become worth almost nothing, and that the warning signs may have appeared long before the final collapse. So, what does it actually mean when people say a stock is going to zero? It does not necessarily mean the market price literally reaches zero. In many cases, shareholders can lose almost all their investment when a business becomes financially unsustainable, enters insolvency, undergoes liquidation, or its equity is effectively wiped out through restructuring. A stock can also become extremely difficult or impossible to trade after severe corporate deterioration. The important financial truth is that owning shares means owning a claim on a business whose future value is uncertain. That distinction changes the way investors should examine risk. A stock price can fall because investors temporarily become pessimistic, but a business can deteriorate because its cash flow is weakening, its debt obligations are becoming harder to service, its competitive position is disappearing, or its underlying economics no longer work. The price is the visible symptom, the business mechanism is the deeper problem. This creates a difficult question: how can an investor recognize that a falling stock is merely experiencing a difficult period, or that the underlying business itself is approaching permanent destruction of shareholder value? One place to look is cash flow. A company can report accounting profits while still struggling to generate enough actual cash to operate, invest, and meet obligations. Persistent negative operating cash flow can become dangerous when external financing is repeatedly required to keep the business functioning. If new capital becomes unavailable or prohibitively expensive, the difference between a temporary setback and a solvency crisis can become enormous. Debt makes this mechanism even more important. Debt does not automatically make a business dangerous. Borrowing can finance productive expansion when future cash flows can comfortably support the obligations. The problem appears when interest and repayment requirements consume the financial flexibility that the business needs to survive unexpected changes. Imagine two businesses experiencing the same decline in revenue. One has modest obligations and substantial liquidity. The other has heavy debt and little financial flexibility. The same economic shock can produce completely different outcomes because the second business has fewer ways to absorb the damage. This is why balance sheet strength can matter more than a dramatic stock chart. Another hidden danger is dilution. When a struggling business needs additional capital, it may issue new shares. That can provide survival money, but existing shareholders may own a progressively smaller percentage of the underlying business. A company can therefore survive operationally while previous shareholders experience severe destruction of their economic ownership. Technology introduces another route toward permanent decline. Artificial intelligence, automation, advanced computing, and changing consumer behavior can alter the economics of entire industries. A business that once possessed a strong advantage may discover that its technology, distribution model, workforce structure, or customer relationship is no longer sufficient. The danger is not that technology changes rapidly, it is that capital can remain committed to yesterday's economics while tomorrow's economics are already forming. History repeatedly demonstrates that technological progress creates both extraordinary wealth and extraordinary obsolescence. Entire industries can once appear indispensable and later become structurally smaller because a superior technology changes the economics of the problem they solved. So why do investors sometimes continue holding a deteriorating stock even when the evidence becomes increasingly uncomfortable? Behavioral psychology provides part of the answer. Loss aversion makes losses emotionally heavier than equivalent gains. Once someone has purchased a stock, admitting that the original thesis was wrong can feel like admitting personal failure. The investor may therefore search for information supporting recovery while dismissing information suggesting permanent deterioration. This creates the sunk cost trap. Money already lost cannot be recovered by refusing to acknowledge the loss. The relevant question is not, what did I pay for this stock? The relevant question is, given what I know today, would this business still deserve my capital? That is an entirely different decision. The same psychological problem appears when investors confuse a low price with a cheap business. A stock trading far below its historical peak may look inexpensive, but the historical price does not determine future value. If the earning power of the underlying business has permanently deteriorated, a lower price may represent deterioration rather than opportunity. This is where financial education becomes more powerful than prediction. You do not need to know exactly what a stock will do tomorrow to understand whether its financial foundations are becoming weaker. Learning how revenue, margins, cash flow, debt, liquidity, capital requirements, competitive advantage, and shareholder dilution interact gives investors a framework for evaluating uncertainty without pretending to control it. And this lesson extends beyond investing. A business owner who depends entirely on one customer faces concentration risk. A worker who depends entirely on one skill faces career concentration risk. A household dependent on one income source faces financial concentration risk. The stock market simply makes the principle visible. Concentration can amplify both success and failure. That is why lifelong learning has financial value. As technology changes economic opportunity, the ability to learn new skills can protect earning capacity just as diversification can reduce dependence on a single investment. Even health belongs in this equation. Financial resilience ultimately depends on human capacity. A person who protects physical energy, mental clarity, and emotional stability is better positioned to continue learning, earning, and making rational decisions during difficult periods. Lord Hanuman provides a profound framework for this kind of resilience. His strength was inseparable from discipline, wisdom, humility, service, and devotion. His power was not merely the ability to overcome an obstacle, it was the ability to direct enormous strength toward the right purpose. Applied to investing, that principle means courage should not be confused with refusing to accept a loss. Sometimes courage means examining the evidence honestly. Discipline means following a rational process rather than an emotional attachment. Humility means accepting that even intelligent investors can be wrong. Wisdom means distinguishing a temporary decline from a permanent deterioration. The Bhagavad Gita's broader teaching about disciplined action without attachment to outcomes offers a similarly practical perspective. An investor can control research, position sizing, diversification, patience, and decision making. An investor cannot control every economic cycle, technological disruption, management decision, or market reaction. So, can a stock really go to zero? Yes, shareholders can ultimately lose nearly all of their investment when a business fails or equity value is extinguished. But the more important question is not whether zero appears on a screen. The more important question is, what happened to the business before the market reached that point? Cash flow weakened, debt became harder to support, competitive advantages disappeared, capital became more expensive, technology changed the economics, dilution reduced ownership, and sometimes, psychology prevented investors from accepting what the financial evidence was already saying. That is the real financial truth behind stocks going to zero. The goal of stock market engineering is therefore not to predict every collapse. It is to understand the mechanisms that make permanent capital destruction possible, and to build the knowledge, discipline, humility, and resilience required to recognize those mechanisms. Let Lord Hanuman's courage teach you to face uncomfortable evidence. Let his discipline keep emotion from becoming your investment strategy. Let his humility remind you that uncertainty cannot be eliminated. And let gratitude keep wealth in its proper place, as a tool for living, learning, serving, and building, not as a measure of your identity. Because the greatest protection in the stock market is not certainty. It is understanding. Stock market engineering. Jai Hanuman.